what we've learned so far in this series is if you're looking for a CPA, you should be reaching out, between May and July, and assume after that point that everybody's booked for the next tax season, and you'll have to wait for the following year if you want to switch. The other thing is we've learned that if you want tax planning advice, which I strongly encourage all of you to get, you're going to go and have a meeting with your CPA October, early November. You're going to provide them financial statements that have been fully reconciled. We talked about reconciling in the last video. So the goal is that you are going to be able to provide them financial statements that you know are as accurate as possible, because now when reconciling, people are doing both steps, marking the things that cleared and investigating the things that are not clearing. If it's a duplicate, voiding it as long as it's in the current fiscal year. And if it's not a duplicate, reaching out to the vendor employee and working on getting the stuff cleared. Credit cards, everything should clear in the moment. If you've got weird stuff in there that's not clearing, it's probably a duplicate or entered in error. So now, my friends, we are going to talk about an account that confuses many and infuriates CPAs. That is called retained earnings. Unfortunately, QuickBooks, in its wisdom, renamed this account in some files, but not all, and calls it owner equity. Well, it is owner's equity, but really it's owner's equity. The entire equity section is owner's equity, right? Like, it's all part of the owner's equity. That's what equity is. So by giving it this name, I only bring it up because for some of you, you might go to look for your retained earnings and you might not be able to find it. So it's going to be on the balance sheet. It's going to be in the equity section, and it should be called retained earnings. I would say, folks, if your retained earnings is not called retained earnings, I would change the name of it because it just makes more sense calling it what it is. So what is retained earnings? Well, it is exactly what it sounds like. It is all the earnings that have been retained or kept in the company. Now, at the base level, it is your profit. So if you look at a balance sheet, you will see net profit is in equity. And that line ties to your profit and loss, also called the income statement. So the profit and loss and the balance sheet are the two most important financial reports. And they connect each other, they tie to each other, because the net profit showing on the profit and loss is the net profit showing on the balance sheet, as long as you're pulling reports that are dated the same period in time. So how does retained earnings get populated with money? Well, the software every year at the close of the year, the software creates an entry like this. It takes all the money that's in net profit and it moves it up into the retained earnings account. And so this example shows that we had a $10,000 loss year one, a $1,000 loss year two, and then we got profitable until COVID times hit, and then things went sideways a little bit, and then things got better again. So overall, what this tells us is that the total profit or revenue created by the company is $187,000. So this is always life to date through last year, right? Because if you look on the balance sheet right now, the net profit is showing for the current fiscal year. On December 31st, the last moment in time, it'll get moved up and put into retained earnings. And the mechanism of doing that is partially because the profit and loss, you start out the year with your profit and loss at zero. There's nothing in that report. It starts out completely blank. And so the net profit starts out at zero. Now, in our last video, we talked about reconciling and how reconciling is a two-step process. Well, here's the scenarios I want all of you to avoid. So there's a check from 2022 that had never cleared, and you told the bookkeeper that reconciling is a two-step process and they have to deal with things that haven't cleared. So they went into QuickBooks and they just deleted the check. And when they deleted the check, it's going to create $5,000 more profit because now that expense vanished. And you should never do this. This is an example of what you should never do. So now, instead of $20,000, we have $25,000 as profit in 2022. But that doesn't match your tax return. And it doesn't match what the CPA had. This is a huge issue. And people that are not actual bookkeepers and newer bookkeepers that haven't been mentored or had advanced training might do this kind of thing thinking they're doing the right thing. They're absolutely not, because now they changed the past. And this is why we need to set the closing date with a password. So as soon as you send your stuff off to the CPA, you should immediately lock the books down. And so there's a way in all software, all accounting software, there's a way of putting a closing date and a closing password. And then no one should use the password. I say no one should use the password, but you could use the password if you're changing names. Like, let's say there was a great big subcontractor bill at the end of December, and you don't notice until the beginning of February that it was to the Miller job when it should have been to the Millens job. You could go back and just change the customer name that was assigned to the transaction. So changing words but never numbers, okay? So if you absolutely have to change the past, it must only be words, never numbers. Never, don't change dates, don't change dollar amounts, never ever delete or void anything. And the problem is some companies are changing the past so much that there's so many changes that occurred, you can't even rebuild it and put it all back in place. It'd just be a waste of time. It's complete chaos. And I've seen this firsthand. So I'm sharing this as a warning. Don't be in this situation. Now, we just created extra profit. Now, what if there was a deposit that was duplicated? It was entered twice and you delete it. Well, now you just got rid of profit, right? Now, let's say it was for $7,000. Now you just lost profit for 2025, and now 2 different years no longer match CPA records. I'm telling you this because the very first thing the CPA's office does when they get your information, and it's your turn in queue, right? Because they always have to go in queue of what they got first. So it's your turn in queue. The very first thing that the CPA office is going to do is compare your total retained earnings for all of the prior years to see if it still matches with their information. And if it doesn't match, then they have to figure out what you did. Because bookkeeping is a double entry system. Every single transaction hits at least 2 accounts. And so if you changed profit, then you must have either changed income or expenses, but it also means you would have changed the balance in the checking account or in one of the credit card accounts, right? Because it's all linked. Now, you might be sitting back saying, well, we don't have to worry about this because we're cash basis. So I can mess with invoices, customer invoices all I want, right? I can go in and change those customer invoices left and right because we're cash basis and invoices are accrual basis. Well, first of all, I commend you for knowing the difference between cash and accrual. That's amazing. But what if the invoice that you decide you want to delete and recreate in the new year? So you've got a December invoice that wasn't populated the way you want, And so you want to switch it out and do a different one. You tell the client, ignore that first invoice, I'm going to send you a new one. Well, the problem is that that invoice could have a partial payment assigned to it, like if you take deposits. So that invoice could have been partially paid. And cash basis accounting says any part of that invoice that was paid is going to be considered income. So the moment that you decide to delete that invoice, even if you're cash basis, it's going to mess up your profit, because let's say there was a $5,000 down payment that was linked. So now that deposit's no longer linked to an invoice in 2025 because you deleted or voided that invoice. While you could link the $5,000 deposit to your 2026 transaction, you just messed with your retained earnings. Your profit for the end of the year is now $5,000 lower because by getting rid of the invoice, you got rid of the connection of that payment to the invoice. And that connection of the payment and the invoice is when the cash basis world says, that's income. So retained earnings is a really important thing to understand. Not that you have to know how to do all the journal entries, right? It's not about that. But what is important is that you understand how vital it is to protect the retained earnings balance and not have it change. The last thing you want to do is force your accountant to go in and dig through everything and figure out what you did. And some of you might be saying, oh, but the accounting software has reports that show us how things have changed, and so we could figure it out. Yes and no. That's true to an extent, but I have had scenarios where those reports don't actually tell us what changed to the full extent. So it's not complete. Much like how you should not rely on your software to store all of your payroll reports that you really need to give to the CPA and you need as a company to keep on file for like 10 or 12 years because of some HR law stuff that is not part of this video today. You also really need to keep your financial statements. So a PDF of your profit and loss and balance sheet, what it looked like when you sent it to the CPA. And then ideally when you get your tax return done and your CPA delivers the documents I'd like you to all collect, you're then looking at your adjusted trial balance or penned up financials. After you put in your adjusting journal entries, if the CPA hasn't done it for you, you're comparing, okay, this is what my software says I have. This is what the CPA had. Do they match? Someone needs to make sure that things are matching up. It is ideal if you have a part-time controller or a superhero bookkeeper that knows how this stuff all works to compare the reports and make sure everything's dialed in before you send it off to the CPA. So when I do year-end close for clients, the first thing we do is say, does history match what the CPA had? If it doesn't, we have to figure out what they changed. If it does, we get to move on to the next steps. But this is a really important piece of the puzzle. And the best thing that you can do, business owners, is make sure that you have financial reports saved, actual PDFs swirled away and saved of these were our final financial statements. These are the financial statements after the CPA's journal entries. And to instill in yourself and your staff that it is not okay to change the past, right? If you need to revise an invoice and it's the current year, yeah, go ahead and revise it if you need to. But don't revise prior year invoices. And definitely don't delete prior year activity after the stuff's gone off to the CPA, right? You can be doing cleanup before you send stuff to the CPA. And that's why the manic rush to just get everything to the CPA, that works if you expect them to take care of all the cleanup for you. But be warned, a time could come when the CPA says enough is enough. You have to take your bookkeeping seriously. We are not going to be doing all this cleanup for you every year, right? Because all the cleanup that they're doing for you, they could probably do a whole nother tax return in that time. So don't piss your CPA off, okay? And the biggest way to not piss them off is to leave retained earnings alone. Don't mess with it. Now, I will tell you one final thing about retained earnings, because some of you might see this in your journal entries and in your accounting system. And that is that the formal, proper way of doing bookkeeping is that at the end of the year, both owner distributions, money the owner took out to pay themselves outside of payroll, and owner investment, monies the owner might have invested in the company, but it's not a loan. They don't expect to get paid back for it. Those two accounts are often closed out to retained earnings. And then retained earnings really truly is what has been retained, because we subtract owner distributions from this. So some CPAs do it, some don't, right? So if you've switched CPAs over the years and you go in and look at your retained earnings activity, you might find that owner distribution was closed out in some years, but not others. If you have a superhero bookkeeper or a part-time accountant working as your controller, they could do those journal entries for you after the fact. They could close out. Now, the closing out of the, for instance, owner distributions, it's normally dated the first of the following year. So that means your balance sheet at the end of the year shows $100,000 owner distributions. And then on the first of the following year, it's now at zero because it's all been moved to retained earnings. So that's the world of retained earnings. It is so important to keep this safe. And the equity section itself, you really got to review it and check it out. I'm finding more and more people they're using the opening balance field, which you should never use. Create a new vendor, put an opening balance instead of entering the bill. Got people creating inventory and putting the beginning quantities of inventory, and it's going to like open balance equity in the equity section, which is absolutely not where it's supposed to be. So we have to be really careful, because the way the bookkeeping is done, integrations can cause this. We don't want our expenses to go straight to equity. We'd like to write them off on the tax return, those little things. And so keep an eye on your balance sheet, folks. Really look at it every month and make sure it looks reasonable, and question things that you don't know. You might question an account and the bookkeeper might not know what it is either, but they should at least be able to look in the account like this detail you see on the screen here and find out where it came from. Sometimes owners take more distributions than they were supposed to take, so the CPA will create an account called loan to owner and restate some of the distributions as a loan. But if nobody does anything with that account, it stagnates for 5 years, that's a problem too. So if you're looking at your balance sheet and you can say, yes, that looks reasonable, no, that's real weird, at least then you can investigate it and maybe ask your CPA about it and ask for their advice on what to do. So protect retained earnings at all cost.